back with the market right here in ET Now. Let me now welcome on board Sharad Mahendra, Joint MD and CEO at JSW Energy, to talk about their earnings. Sharad, great to have you today on ET Now. Your PAT has declined despite resilient EBITDA because of the higher depreciation and finance costs. As more projects get commissioned, should investors expect PAT growth to catch up, or will higher depreciation and interest continue to weigh in on your earnings?
See, we have to remember that this is a 3:1 debt to equity business. And when we have commissioned a large capacity of close to a gigawatt now, or 873 megawatt during this quarter, which results in more of the debt and also the capitalization. So interest and depreciation, both definitely is going to remain on the same trend, which of course also take care into the net profit level. So this trend will likely to continue, and this is the nature of the business. But maybe as and when now the RE portfolio, what we have been capitalizing in last 2 years, 3 years, is to be, and the repayments also are increasing. So maybe it's a matter of a year or two when this trend reverses and also the PAT level starts going up. So this is something which is from the RE point of view, this trend will continue. But overall, if you see that maybe what we have given the guidance, and that is on track, that in maybe in FY28, we will be commissioning one unit of 600 megawatt of thermal business, which definitely will start giving us higher margins. So which will then this PAT levels will start increasing. It is the EBITDA percentage margin we have to see at a healthy in excess of 55% EBITDA margins. Once that is there, and we also have to watch the cash profit, which is very important in this nature. The nature of business is such. The cash profits are healthy, continue to increase, which helps us in ensuring that the guidance what we have given in terms of the capex and the new fresh capacity addition growth is remained on track.
And hi, Mr. Mahendra, what's the, you've achieved already a third of your FY27 capacity, right? In terms of the addition target, is there scope to exceed the 3 gigawatt guidance for FY27? And if not, what's the biggest execution bottleneck currently, if you can give us a sense? Would it be equipment, transmission, approvals? What would it be?
See, one thing which we have to see that last full year, the greenfield capacity addition was almost close to about 1.26 gigawatt full year. And as we are talking in first 100 days, we have already done 1.1 gigawatt. And maybe in H1, means end of Q2, we are absolutely certain that we'll be adding fresh capacities in H1 alone in the current year of 1.5 to 1.6 gigawatt, which is more than what we did in last full year. So we are absolutely confident that 3 gigawatt capacity addition, what we have said, is on track. This all is keeping in mind the constraints of execution on ground, right of ways and others, and also the connectivity related issues. Everything kept in mind, we are absolutely certain that this year we will be definitely adding 3 gigawatt of fresh capacity, which is all in RE space, which is much significantly more than what we did in entire full year through the greenfield route in Orkney.
Right. And your capex deployment, that has accelerated sharply. Are new projects still meeting your target IRRs, or is increasing competition beginning to pressure returns?
No. What we have benchmarked, our benchmark mid to high teen IRRs that are absolutely protected, because the competitive landscape has changed only with huge participations and tariffs coming under pressure in last, and also the project cost execution. For all these things, if you see that in last 1.5 years, maybe more than 15 months, we have not participated in any of the bids in the RE space. And we had already contracted for the supplies for what we are doing now much earlier when we have seen in recent time the cost going up. So our returns, what we have benchmarked, what we have estimated, are absolutely certain and are protected.
Okay, and power demand, that's remained robust, yet revenues were largely flat. This is, my understanding is that is because of weaker hydrology. Should investors view this as a one-off? Is this likely to remain a recurring source of revenue volatility of sorts?
No, I think this has been one off, and the prime reasons in quarter one, if you see that one of the significant change, the benefit of that on revenue and margins, which we will be seeing quarter two onwards, as compared to last year, is the Utkal plant. Utkal plant last full year has been on merchant basis, and there was no power purchase agreement. And we have seen that last year, quarter one, in the month of April and May last year, and part of maybe 10th to 15, 10 days or to 15 days of quarter in June, has been very good comparatively what we have seen in rest of the year in terms of the demand and the tariffs discovered, which gave us the benefit in quarter one last year from Utkal plant. But after that, what we have seen is the negative demand last almost full year, and also the severe decline in the merchant tariffs last year from quarter two onwards. So these all resulted in that last full year, the demand growth was 0.9% growth, and also the tariffs also in merchant were very, very low in the balance part. This year, we have signed, as we have announced earlier, the capacity. Majority of the capacity we have tied up under long-term PPA and the short-term PPAs, out of which 400 megawatts with the state of Karnataka under 25 years PPA at a tariff almost at 5.5 rupees 79 paisa, and with state of Assam for a 2-year power purchase agreement of almost at 5 rupees 85 paisa. So these are the two things which we are going to be significantly in terms of the margins are going to get the benefit when we compare to merchant from Q2 onwards. So I am absolutely confident that quarter two onward will be the real benefit will be coming in terms of the revenue, in terms of the margins from is driven by Utkal plant and the merchant sales from our Mahanadi plant going forward.
Right. So as renewables become a larger share of your portfolio, should this revenue volatility reduce over time?
Yes, definitely. Yes.
Good to hear that. So with the balance sheet significantly stronger after the QIP and stake monetization, has your capital allocation strategy changed in any way?
See, as we have announced and we have given the guidance that of current year capacity addition of 3 gigawatt and the capex is starting to in the thermal space with one of the 600 megawatt unit from Mahanadi will be commissioned in FY28. So these are the things which are well in place, and what we have given the guidance of almost a 20,000 crore capex in the current year. This all is on track, and this fundraise through various modes, 3 modes. One was the promoter equity infusion, part of which has already come, plus the fundraise through the QIP, and also the steel share sales, which has given us a comfortable level of debt to EBITDA ratio of 4.95 when we reduce the construction work in progress related debt gives us a comfortable room. We have been successful in deleveraging our balance sheet and ensuring a comfortable plan towards the growth, what we have announced in the current year of 3 gigawatt capacity addition and going forward for 30 gigawatt by 30.
And what part of the JSW Energy story, sir, do you think that the market is still underappreciating at this point?
I think market has acknowledged two things. One, the balance sheet deleveraging, what we have done through the fundraise through three different modes. In last quarter of the fundraise and the steel shell shares and bringing in and deleveraging the balance sheet is something which I am confident that now market will be acknowledging and appreciating. And second is also in terms of the rate at which we are adding the capacities, fresh capacities, as when we compare with last year, as I told earlier also, of almost in first 100 days, including 225 megawatt of capacity addition, what we have done in July, almost a capacity addition of 1.1 gigawatt is what I'm sure that is going to add and strength to our realizations, the profitability and the margins, which I'm quite sure that now going forward, market is going to realize and appreciate.
Right, Mr. Mahendra, great to have you today on 80 Now. Thank you so much for highlighting what the quarter visibility and going forward, of course, it's like.